guys, Freaky Finance here. Today we're doing a fun video on Burford Capital. Probably one of the most unique business models I've been able to dig into in a while, probably in the life of this channel. And yeah, let's get into it. I should say before I start that I do own a very small position in Burford. I just started it because I want to start tracking it as we go into this big case that we're going to talk about in the video, YPF. But we're going to go into some basics before we jump into that. I was looking at other content out there, and a lot of these articles call Burford more of a consignment for lawyer fees, and that's partially, I would say, correct in like the very superficial, but it's wrong in terms of what Burford actually does. Basically, Burford Capital pays the legal bills for people and companies they believe will win a lawsuit, so they have to make sure their underwriting is pretty strong and they have a good pulse on what the likely outcomes will be. Like, how strong is this case? Can they win it for these guys? And basically assume all the risk in doing so, which is a lot different than consignment. So, and the AI here says it perfectly. The business model appear to have shared traditional characteristics with consignment. In both scenarios, an asset owner, physical goods, engages a third party to help realize an asset value. That's about it. That's about as far as these two things are together. One of the biggest one, and this is going to be critical for the purpose of today's video, you need to understand this core concept, is the concept of non-recourse. Basically, Burford's investments are entirely at risk contingent on the outcome of the underlying legal matter. So if a funded case is unsuccessful, basically Burford loses their investment in that case and all the expenses that they incurred to fight it. The client owes Burford nothing. You only get the upside, the expected outside, if you're successful, whether that's settlement or for actually collecting it. So that basically transfers the risk to Burford. So Burford really needs to know what they're doing in order to do this type of work, which they have a history of actually performing. So it's worth bringing that up too. They do offer quite a lot of financial solutions. So they have the fees and expense finance, provides capital to cover all costs associated with pursuing a high value commercial dispute. Here, Burford is providing immediate non-recourse cash advance to a client against a portion of anticipated future proceeds on a claim. Here's probably one of the more, I would say, stronger areas is how you have all these binary events, whether are they gonna win the case or not. But what they've done is basically pool them together, and so that there's diversification within. Some cases you're gonna win, some cases you're gonna lose, but overall it'll help streamline. And especially if you have a good win percentage and settlement percentage like these guys do, basically you're gonna have this rolling thing be favorable, and it should lower your cost of capital, which should enable them to keep doing this. And that's something a lot of other legal teams don't have, right? And this will, I think, especially if they continue to be successful, especially if they are going to be successful with the YPF case, this should also further reduce their cost of capital because they're going to be seen as kind of like they already are, as very successful and astute underwriters of risk and knowing what cases to pick. And then they also have an arm for actually collecting the assets and helping people collect assets after they win a case, because that's sometimes not winning is not enough. Settling, right? You actually have to collect the assets. This is very important. It's basically, how can I finance the prosecution of this contingent asset, transfer the risk of failure, and manage its impact on my balance sheet? Just made AI extract this too, just to show the differences. Consignment is all about risk avoidance. It's like, this is a good example. So I write a book, I go to chapters. I have to write the book. I have to buy the inventory. I have to distribute it to chapters, put it on the shelf. And if it sells, chapters gets a big cut called a consignment fee, and I get the remaining amount. But I do all the work. It's my asset, not chapter's asset, until it's sold. That's totally different mindset than what Burford's doing here. Basically, they're taking on 100% of the risk right up front. It's capital intensive because they had to come up with money up front to actually start these things and take a cut into the future expected proceeds if they're right and win the case. And there's another core accounting concept which had a lot of, I'd say, muddier waters in the last 5 years, because this is more of a judgment thing, and it's hard to ascertain this with any degree of certainty, because all these cases, like, you could say it's more probable after a favorable thing, but you really don't know at the end of the day if you're going to be able to, if you're going to win that case and if you're likely to collect on it. And so it makes this hard, and it's a little bit of judgment in here, and we're going to go through that really quickly as well. But it's a very interesting accounting case. Here you have settlement. So this just helps shows how successful they have been. Of their deployments, 78% settle in 2.4 years. So when they deploy capital, they generally get people to settle pretty quick. 15% of the time, they don't settle, they still win. and then 7% of the time they don't settle and they lose. So that helps show you how strong these guys are in terms of their knowing what they know, really, in terms of legal, what cases to pick, what things to swing at, right? This baseball analogy here is perfect. They get to pick what they want to invest in and why. Like, why should I take this case over this case? And they have a good history of doing that. Here you can just see the funnel, so the underwriting funnel. So they have inquiries and opportunities, then they screen them, so filter a bunch out, diligence and pricing, filter more out, commitments 55, funding agreement 41. So you can see from 2000 to 41, they're definitely being selective and choosing the ones they think they can win. Book value per share, you can see here, this is what I mean by long-term value. Now, so it shows me that they know what they're doing, but it also should help show like that it can be volatile. Some years are going to be way better than others. Some years are going to be worse than others. And this uncertainty, because legal cases are uncertain, can lead to this non-linear line, which markets generally don't like. So you're going to have a year where it's bad and the market's probably going to overreact to it. You're going to have a year it's good and the market's probably going to overreact to it. And it's also likely to assign a lower multiple than you would say for like a Pepsi or whatever, something stable, or that say at 17 or 20 times earnings. You're likely not to get that kind of multiple with this company, but you're likely to get, I'd say, in the 10 to 12. But that's someone's opinion. In terms of the income statement, pretty interesting business. So you're going to see here capital provision income's like their biggest one. That comes from the capital assets. But the coolest thing here, the more interesting thing here, is you can see in terms of their salaries, like it's a, I would say, relatively small amount against their long-term incentive and share-based comp. So there's a lot of alignment here and a lot of long-term thinking involved with who they're hiring to win these cases, because these cases take years. And you can see that these are not small amounts relative to salary. That is almost 100% of their salary expenses also going to long-term incentive compensation, right? So basically the partners or the lawyers and even the support staff perhaps have a incentive here to stay and ride these things through, which is also going to be important. And obviously a lot of it's getting paid on incentive. So if they perform, they're winning cases, getting settlements, they're getting paid. So there is that function there. Like some of it is a fixed cost, but the salary is more, I would say, quasi-fixed than we're used to seeing for other companies. Here, just because it stands out like a sore thumb on the balance sheet, you can see capital provision, $5.2 billion. It's the big one. Debt payable. So they do have some debt, $1.7 billion. And part of that is just getting capital, trying to lower the cost of capital by being successful. And that allows you to further, like if your cost of capital is only 7%, but your ROIC is 83% and your IRR is 26%, basically you could do that all day. As long as you put up these numbers, and you can borrow at 7 or 10 even if you needed to. Here, just another way to show alignment, that founder led with team owning 10% of the company. So there is some skin in the game here with the big guys at the firm. In terms of the cash flow statement, I also want to point out, because it's volatile, it is super volatile. Instead of like traditional working capital, you have proceeds from capital provision assets, so realizing the assets. Then you also have deployment of issuing new capital to basically take on future favorable settlements. So you have these two things constantly at odds with each other year over year. So a cash flow statement for this type of company is going to be all over the place. And technically, the worse it could look, technically the better it could be in the future, right? Because basically they're investing a lot of cash basically to try to win with the new opportunity set that's coming up down the line. So it's a little bit, I would say, this out of all the statements, this one's probably the most unusual, and it is relatively capex light in the traditional sense in terms of PPE, right? Because it's mainly this capital intensive of coming up with the money up front to buy into the cut of the future expected proceeds of the legal settlement. Here, so they say it's at fair value. I thought this was interesting. The risk adjustment factor for any objective event, which is defined here, significant positive ruling, a favorable court or favorable judgment of the first appeal, an objective negative event, right? Exhaustion as they're all right of appeals, and arbitration case where there are limited opportunities for appeal. So these are all objective events, and here's a good example. So assume risk premium at inception is calculated at 65%, which is held constant until there's a milestone. So if there's a favorable court ruling, they'll reduce it by 50%, which would reduce the risk premium to 32.5. And basically this would allow them to start realizing some income, basically saying the odds of us being successful are higher than we thought at the time. Alternatively, as negative, they go the other way. So now they'll have a risk premium of 82.5%. Basically, start discounting the future probability. So basically, the future likely amount is being marked down lower. and the opposite when it's favorable, the future likely amount is getting marked up higher. And here is a confusing spreadsheet. This is probably one of my favorite on the 10Q on page 35. You can see the discount rate 6.5 and the duration 2.7, which they reference, and the adjusted average risk premium is 31%. You can see it really depends the positive case milestones, like where they're going. You can see min and max. It's a lot of judgment here, which does make it hard to know what something's really worth until you actually get the money from the settlement or from actually collecting the assets when they win, right? Here you can see when there's appeal judgment that's negative, you can see they mark it down 100%, which is good. That's what you want. You don't want them to just say something could still be worth something when they've lost. And here we're going to bring out the big one, the one that most of the analysts are focused on because it's so big, and it's going to be a very either big value unlock or value killer in the next year. So anyway, we'll see how this plays out, but I just want to point out that it is a big one, YPF. Here it's another way to show the big guy capital provision assets, 3.8 for Burford only, 3.8 billion. And you can see of this 5.5 here, a lot of it is in the portfolio. So there is the big single case, but a lot of it is in portfolio. So that's why we're kind of focusing on the portfolio asset. That's why I kind of went here for the portfolio part to try to see exactly what's in it. And it is a lot, in my mind, judgment, which makes it hard for someone like me who's not used to following this company. So that's why I have a very small position, because I want to start following it, especially as we go into YPF and the appeal case that's currently ongoing. Another way to show the 3.8 billion. Here's the 5.5, here's the 3.1, or 3.8, here's the 3.8 here. So capital provisions for Burford only. So we're going to focus on this. And you can see YPF is a large portion of this 3.8, 16.23. So it's going to have a material impact on the company. The outcome of the trial and the ability to collect, or do they settle? Like, what's the recovery amount going to be if it's likely that Burford is successful, which the AI thinks they will be successful. It just doesn't know how. Spoiler alert, it just doesn't know how able Burford will be able to actually collect and how long Argentina will drag its feet. So anyway, there's an oral argument coming up October 27th, 2025. Today's date is August 30th, 2025. That's worth bringing about. They do have 35% proceeds from the Peterson case, around 82%. We'll talk about these really quickly in a second. These are the two impacted parties that Burford is representing. Here's some backstory from the Burford point of view. We have another one from the AI point of view, and the AI is really good at doing this historical stuff and digging into things. So we're gonna go on a tangent there and drill into this one case just because it was so interesting. So this video is going to be a bit longer, but it is a more complicated company. So Argentina breaches contract with shareholders for failing to tender. Basically, it just took it. It took the shares from the public market. Basically said, investors, you get nothing. Basically, this company really got screwed over. It had no money left, so Burford gave us some money to basically take these guys to court. Anyway, there's a jurisdictional phase litigation where Burford won. Eden Park jumps onto the case, the third largest holder. Merits phase, so this is where you got the damage, the big one, it's $16 billion. And now we're currently waiting for the appeal. Discussion here is just another point of view, and this is important for the collection part. Argentina hasn't historically been a strong place to recover assets when you invest. It's not investor friendly, or at least it has a history of not being investor friendly out of most of the countries in the world. But basically here is a slide from Burford trying to say, hey, the Argentina's actually gotten better since the new guy, chainsaw guy, has gotten elected, which is true. It does look like it has gotten better since he's been elected, making hard changes. But that's just from a numerical point of view. I don't live there, so I have no clue. Anyway, here's the path to enforcement and some history on it. And here's the AI basically saying that Burford Capital maintains a high probability of success in defending the underlying $16.1 billion judgment on appeal. However, the enforcement compelling to transfer the shares, an asset located within Argentina, faces a more challenging and uncertain appetite review. The uncertainty is magnified by the intervention of the U.S. government, which has raised significant concerns about international community and foreign policy, specifically in relation to the extraterritorial application of a U.S. court's enforcement power. Just because you win, does that mean you can go into another country and take their assets from them? And that's something the AI struggled with. The AI was kind of almost cavalier, and it's like it very much thinks that Burford's going to win. I think it signed it between an 80 and 90% probability. But if they win, can they, so what, right? Can they collect? Anyway, so, some backstory. An unconventional acquisition. This is the AI's words. Basically, they acquired a 25% stake, the Peterson Group. His family had a history with administrations of the then president, Nestor Kirchner, and his successor. And this line is funny. So the Peterson Group basically acquired a substantial minority position without investing any of its own capital. And that's kind of true. Basically, what it did is got a whole bunch of banks together. And then both Repsol and the banking syndicate agreed that these loans would be serviced and repaid exclusively from future dividends distributed by YBF on the very shares being acquired. So basically, we're going to get a bunch of money, and the only way we can pay you back is with the dividends of the company that we're buying. Which sounds interesting, right? But what happens when, in this case, the government of Argentina takes your assets away and then decides to no longer pay a dividend? And now you're technically bankrupt because the only way you're allowed to pay them, as expressly written, is through the dividends that you get, which you're no longer going to get. So anyway, and it's also, this is basically the one president bringing in international capital, trying to get, because Argentina had a crisis earlier in the 2000s, and this is them trying to get people to invest in Argentina again, and then they immediately nationalize it. And it gets even worse. The timing of when they nationalize it occurred shortly after confirmation that the Vaca Muerta shale oil and gas deposits positioned YBF as a vehicle for enormous future wealth. So basically right after they confirmed, like, yeah, this is going to be big. Now they nationalize it, basically take all the upside from the investors. And immediately following the state's takeover, the new management, now controlled by the government, announced a halt to all dividend payments. And the policy was to reinvest all profits back into production exploration, which I could understand. But again, when you have a company that owns 25% of your business, that can no longer make its loan payments because you cut the dividend that the loan was tied to, it's just a crazy setup. AI thinks that Burford only paid 15 million euros at the time for the Peterson Group part. I don't know if that's true or not. The AI didn't source it here, so I have no clue if that's fair, or even if they want to disclose that at this time. They've made materially more than that already. They've actually decreased their exposure already by selling some of the expected proceeds to other people already, this Burford has. So that's worth pointing out. They've already locked in, like, this is going to win them money no matter what, which is nice and something I would do if I was in their shoes, especially given how confident AI is that they're going to win. So that means people are likely to pay up for it. Anyway, here, jurisdiction. So the litigation campaign, and AI here says that was a masterclass in strategic litigation, navigating complex jurisdictional challenges, and culminating in a summary judgment that established Argentina's liability before finally proceeding to damages phase, which maximized the final reward. And that's all true. That has actually happened. So we're going to go through it real quick here. But we'll start with the jurisdictional one. Basically, Argentina's like, you don't have jurisdiction. We're Argentina assets. This is Argentina. Why is the U.S. courts trying to get involved? The Republic of Argentina argued that as a sovereign nation, it was immune from the suit and that the dispute should be adjudicated in Argentine courts. Battle lasted for years, and basically the U.S. or Burford won this one partially because they list all their assets in U.S. soil through ADRs. And basically they're like, okay, so you want to come to our country and raise money and then get the money and then basically steal the money from them so that you can take the assets in Argentina. So if foreign investors invest in you, then you just take their money from them, right? So that was probably too bad to be true. So that's what the judge decided on. So the jurisdiction initially failed, and then you have the summary judgment on the liability to find out who's liable. So here they exonerated YBF, the company itself, which is important because that's the claim that we're trying to get, is trying to get our 51% ownership back. So basically the court held that YBF itself is not liable. Basically the liable party was the Republic of Argentina because it relies solely on the party acquiring control in this case, and not with the company whose shares are being acquired. This was also funny. Argentina tried to basically say that the plaintiffs, so in our case Burford Capital and the affected parties that got destroyed, basically lacked standing to sue because their shares had to be transferred to creditors. So basically they're saying you can't sue us because you were already bankrupt at the time. And that's in my like, okay, they're bankrupt because you made them bankrupt. They had a loan that was tied to the dividends and you canceled the dividends immediately after taking over the company. Obviously the judge decided with Burford here, clear contractual breach, and then the Republic failed to make a tender offer. Basically you're just trying to give people a fair value, whatever the price is. Fair can be a big term, but you have to give them something, some type of consideration. And that was not the case here. Anyway, at the time of this was a big thing in March 2023. Basically, it's like, yeah, you have a case here, and one party is entitled to judgment as a matter of law. So you can see this in March 2023 shooting up. In September 2023, we got the damage ruling. And it was not to relitigate the breach, but to the court to hear evidence. And basically, the damage ruling was probably even the best one yet. Basically said the Burford gets everything they want. So $16.1 billion, big case. Obviously, their portion is less than that, and then whatever they collect will be less than that, and when assuming they eventually do win. But anyway, here you can see the control date. Basically, they say it was right when the government of Argentina took over, which is when the share price was higher, obviously. And ultimately, when you start nationalizing things, you're going to put pressure on your entire stock market. I just find this so fascinating. And then you have the prejudgment interest rates. So basically, because it's been so long, they decided to set an 8% interest rate starting from May 2012 to the date of judgment. So that's almost a decade, more than a decade of 8% interest rate. So that's compounding as well. So that also shot up the damages. And here you can see of the 16.1, 14.4 for Peterson and 1.7 for Eaton. And this judicial decision implicitly recognized that the harm was not just a one-time breach, but a prolonged and wrongful withholding of commercial funds, justifying a punitive commercial rate and further cementing the non-sovereign commercial character of the dispute. So basically, this type of judgment here, in terms of the damages, basically says you guys did something wrong and we're hitting you as hard as we can because you know you did something wrong and you continue to do something wrong the entire time after the fact. So that is a strong statement. Obviously, Argentina appealed it. That's where we are now. Argentina's central claim is that its actions are sealed by the FSIA, so the Foreign Sovereign Immunities Act, based on the Sovereign Act of Expropriation, and not a commercial act, which so far none of the courts have agreed with. They've also always continued to say it's a commercial act. Again, they're trying to talk about judgment and a jurisdiction here. Again, U.S. courts lack the authority to compel their transfer, regardless of the merits of the underlying judgment. Burford's going to argue here that Argentina's failure to adhere to commercial obligations as assumed when it stepped in to be the shoes of a commercial actor and had a direct effect in the United States due to YPF's New York Stock Exchange listing, previously endorsed by the Second Circuit in this case. By exercising control of YPF shares that were listed on the New York Stock Exchange and subject to SEC regulations, Argentina was used for commercial activity in the United States. The court's logic is that a sovereign cannot voluntarily enter U.S. capital markets to its benefit and then claim immunity from the rules and contractual obligations that govern those markets. Basically, you can't just start taking money from people, putting the assets into your sovereign country, and then giving the investors nothing after the fact, basically stealing. Here is the probability analysis of this is what the AI thinks. So they think of the 16.1 billion, they think it's probable that the Second Circuit's going to give 85% chance that Burford's going to win. This is where I'm not sure if this itself could be slightly higher than what might happen. But here, the turnover order, AI only thinks 40 to 50% of it will be collectible. Forceful intervention by the U.S. government to the point is a major factor. All right, it obviously sends a bad message when you're going into a different country and taking their assets from them, from a sovereign country, right? That has diplomatic implications. So that's something that's also thinking about. That's why the AI's thing is only 40 to 50% collectible. And then there is a chance that they could appeal again and go to Supreme Court. However, AI thinks it's low, partially because the AI already passed, or the Supreme Court already passed on it, already denied a review once before this case, in a preliminary jurisdictional question. In terms of the company, you can see it's kind of been sitting around ever since that main big judgment win, basically finding the government of Argentina liable. You can see it's been relatively fat, even though the damages right here did shoot up. It came all the way back down, basically, even though they basically got all the damages they wanted and more. And it kind of confirmed the prior judgment, given the punitive interest rates and the word choice. In terms of who owns it, quite a few people own it. I'm not sure how I feel about this because the ranks are so big here and the weights are so big. Some of these guys could be basically, they're going to either outperform the market or not based on this case. And that's a weird place to be in for a fund, right? It's one thing if me, the individual, but when you're a fund that manages people's money, can be different. Mythac we've ran into once, so I'm familiar with them. It's quite a big stake. They like volatility. They're in Children's Place, right? They're the ones that saved us in that one video. Contrarian is one I do follow, so I am interested that they're in this one because I actually respect a lot of their choices that they've made over the years. But a lot of these I don't know, but I do know that they have quite a high ranking, right? This is sorted by ranking. You can see a lot of these are 1s and 2s and 4s. That means they have a decent sized position in this type of binary event, which is interesting. AI, in terms of trying to value it, basically it relies on some of the parts. That's what it says the best thing to do. On the YPF side, it says of the 6.2 billion entitlement, which equates to 28.18 a share, it can't be taken as face value because we need to discuss the chance of not actually winning. Then you need to discount the chance of actually collecting the money, and then you need to discount how long it takes to collect the money and the high nature risk of the asset. So here the AI assumes a 10% cost of capital, a recovery rate between 50 and 70, which I think might be high, but I don't know. And then the probability of actually winning, I think, is high, and I think that's probably right based on what we've seen so far. The central thesis of this analysis is that while the district judgment in favor of Burford Capital is legally robust and likely to be substantially affirmed in appeal, the path to monetary recovery will be protracted, a multi-front campaign. Argentina has a well-documented history of deploying extensive procedural delays, resisting enforcement of adverse judgments, indicates that a final non-appealable judgment is unlikely to be in place until early 2027, right? And this is far later than what most channels on YouTube are talking about. And this is something we've seen in other, not necessarily legal things, but on like biotech side, people often underestimate how long certain things take, even if they're likely outcomes. These things just take longer than you think. And part of me is like, well, this is a binary event, I should look at options for playing this. And the other part of me is like, well, how can you time this through theta unless you're just trying to rule it each month? That's just a different topic entirely and how to try to play this thing. Anyway, there's key variables influencing the deliberation time, case complexity. The AI thinks this case is relatively complex. Novelty and importance. So basically, when the U.S. judgment against a sovereign stake seen as important, and then you have the foreign relations implications, so likely to be more thoughtful about that approach as well. And then you have potential for dissenting opinions, which I'm not sure if there will be or not. Anyway, the primary target is legal for YPF shares. Burford will vigorously pursue the enforcement of this order, assuming the judgment's final. Basically, it will be that the YPF shares, although are located in Argentina, have lost their immunity from execution under the FSIA. They'll contend that the shares are used for commercial activity in the United States because Argentina uses its controlling interest to direct YPF's commercial activities in the U.S., which includes listing its shares at ADRs on the New York Stock Exchange and selling debt to U.S. investors. Thought that was worth bringing up. Here's, you can kind of see like AI basically made 3 scenarios. Again, the oral argument's October 27th. Here's, you have 4 different dates of when the decision could be issued. You can see Q2 earlier end, Q4 later end for pragmatic. The AI thinks that a pragmatic one's the most likely one. Sovereign quagmire, obviously, if Argentina takes forever and drags their feet the entire time. This could draw out very far, right? So you have minor assets starting to get realized and then the larger assets. So these things take time. But it will be interesting to see how they account for that, because when I looked at a lot of it was judicial. So like if probability we're winning the case goes up, hey, we won the case, right? That's great. Maybe they mark up a lot of the accounting and then they just have to try to collect it after the fact. Or how does that work? Do they also discount the chance that they can't recover all what they just won, right? Like how does that how does that work? So that's something I'm going to try to follow and get my understanding up on, because this is something very interesting in terms of accounting, because it's so conditional. And then even if you win the condition, you might not still be able to collect all the money that you thought you were going to. So anyway, I'm getting a little bit ahead of myself here, but I just thought this was a fascinating case, a fascinating business to read into. In terms of the valuation, I got to do its sum of its parts. So the 16.1 billion here from YPF judgment, Peterson and Eaton's portion. Basically, this is why I think 6.2 billion is entitled to Burford. The core business, so without YPF, AI thinks that the business can generate $1.2 in EPS without YPF on it, and gives it a 10 to 12 multiple. So basically, it says its core business is worth $13 without YPF. Here we talked about this really quickly, how it's discounting it. So of the 6.2 billion for YPF, AI thinks there's only 85% chance of winning the appeal. So that marks it down to 5.2 billion. Adjusted for collection discount, they assume a 60% recovery rate, which I'm not sure if that's reasonable. So that's 3.16 billion, and then they discount it over 4 years because they think it'll take over 4 years to collect all the money. So basically, the risk adjustment rate is 2.16 billion, or $9 a share. So if you do a 13 for the core business, 9 for YPF after the big discounts, for assuming that it's going to be harder to recover everything that you won. you get a contingent sum of the parts of 2280 share, right? Which is not bad when it's around 15, right? In that 14 and 13 area, it's not bad at all. Anyway, I'd like to know your thoughts on Burford. It's a different type of company. It has this binary risk, which I know favors options. It's just so hard with theta and deciding when to get into these things. You can see that there's a lot of smart money in it that obviously also think the case is likely to succeed. But it's just, how do you enforce that after the fact? Now, Burford has a history of enforcing things and collecting things and figuring out ways to recover the money. So maybe they're good at that, but Argentina's also has a history of basically delaying and not giving money. It's one of the reasons why, if you look at forward PE for the whole Argentina space, very little of them are over 8 times earnings, right? The biggest company is YPF for Argentina, publicly listed. Like a company I could buy would be YPF. So it is critical to this economy, and it's probably critical to the entire industry or the sovereign area of Argentina. If they want investors, foreign investors, to invest in their country, then they're going to have to start following laws and rules and not just nationalize things after they find out and confirm that there's, oh, this could be exciting, good for the country. We're just going to take it and not give the investors anything, and then slash the dividend, put companies that own 25% of your biggest company into bankruptcy. It just blows my mind. But anyway, I'd like to know your thoughts. It's such an interesting case, so I'm going to follow it anyway, even if I don't have a large position, because I went down enough rabbit holes this week on reading through it. And yeah, have a great rest of your week.